Hello, and welcome to this revision aid for ACCA P5 Advanced Performance Management. My name is Anthony Andrews from London, and I work as a senior accountant for a multinational construction company. I'm also an alumni of the Leaders of Tomorrow program for a global accountancy body. This recording is an introduction to strategic management accounting. So, are you able to explain the role of strategic management accounting in strategic planning and control? This is one of the learning outcomes and one of the syllabus areas, and is one of the very first things that we're required to do as a management accountant looking at performance management. So, strategic planning and control. When an organization decides to plan and puts that plan in action, and therefore needs to control that plan to make it happen, what does the management accountant actually do? This is where strategic management accounting comes in. So, a strategic management accountant has to emphasize the importance of information. Information is one of the key things that I do and I process and that I present as a management accountant in my own organization. So the information that I put together is not just financial, but also includes non-financial. It has to be relevant to the organization's strategy. So I'm talking also in general terms as well as what I do myself. You have to be able to monitor an organization's environment, not just what's happening inside the organization, but also externally as well. And of course, as I mentioned earlier, there needs to be a mix of financial as well as non-financial information. That is both quantitative, i.e. numbers, and qualitative, i.e. description, analysis, and recording of what's happened and why it might have happened. So going back to the first question, the role of strategic management accounting. The role of strategic management accounting when it comes to planning and control is very much based on information. If we look at planning specifically, what does planning mean in the corporate environment? What does planning mean when we're talking about strategic planning and control? What does planning mean to the strategic management accountant? One of the key things that we can look at, one of the key models, is the rational planning model. Now, you would have seen this in earlier studies in ACCA P3 business analysis, and perhaps even earlier studies or other studies as well. Now, the rational planning model is broken down into three areas, and one of the key three areas that we need to look at in terms of planning is that we need to analyze, and this is where we have the mission statement coming in, what the aims of the organization is or are. We also need to look at the external environment where we conduct our PESTEL analysis, or we have a look in terms of strengths, weaknesses, opportunities, threats, i.e. a SWOT. We look at both the external and the internal aspects of the organization, and we use that to actually analyze our environment internally and externally to find out what's going on. What does this organization need to do? Once we've analysed everything, once we've captured all that information, we then need to make decisions, and that's where strategic choice comes in. So with the three areas, we start off with strategic analysis, and then once we've got all that information and analysed it, we then need to make a decision, and that is strategic choice. Now, with strategic choice, again, that's broken down further, and there's different ways to come to a decision. There's different models we can use. For example, if something is suitable, feasible, and acceptable, that's our strategic choice. Then we have implementation. Implementation is the third aspect of our rational planning model, and it's the phase where we actually take our decisions, and we have to then make them a reality. We have to then make sure that what we discussed in the boardroom is then implemented down and throughout the organisation, and that's where our control aspect comes in. That's where our feedback comes in. That's where we need to actually walk the walk and not just talk the talk. So that's strategic planning. So let's have a look at some of the other requirements in the syllabus that's related to our introduction to strategic management accounting. One of the things that we're required to do is to discuss the role of corporate planning in clarifying corporate objectives, making strategic decisions, and checking the progress towards the objectives. Quite a mouthful, may not mean anything the first time you hear it or read it. What we're talking about here is touching upon some of the things that we've just discussed. Discussing the role of corporate planning in clarifying corporate objectives. Again, that comes back to our analysis. We're clarifying corporate objectives. Therefore, what's our mission? What's our purpose? What's our rationale for existing? What is this company trying to do? We need to understand our corporate objectives in order to be able to plan and in order to be able to perform strategic management accounting. What are the corporate objectives? How can we clarify that? Do they need to change? Do we need to update them? Do we need to modify them in any way? We also need to make strategic decisions. That comes back down to strategic choice if we look at the rational planning model. We need to check our progress towards the objectives, and this is one of the key things that this ACCA paper looks at and tries to examine. It's advanced performance management, so therefore it's almost assuming that we've done our analysis. We use P3 for that, business analysis, ACCA P3. We analyse the business. We made our strategic choices. We went into the boardroom, we sat down, the CEO, the CFO, all the other board members, both the non-executive directors as well as the executive directors, going back to P1, accountant in business or professional accountant. We have sat down with our corporate governance hat on, and we have been part of the team that make the strategic choice. P3, P1. Coming to P5, one of the key things about P5 is that what we are trying to do essentially is take all of those things and actually make them happen. Take all the ideas, make them happen. All of the analysis that we've done, all the tough decisions that we had to make, if we can't actually make those decisions into a reality, then essentially the business will struggle and ultimately fail. So the key thing about this ACCA P5 paper, and the key thing that we need to do in our role as strategic management accountants, is to make sure that the decisions that have been made are actually implemented. And so therefore, as part of this syllabus area, making strategic decisions and checking progress towards the objectives. Now, as we go through the syllabus, we'll come to understand that the way that we can check the progress towards the objectives, the way that we can find a model or find a system of doing that, is to use critical success factors, and from those, key performance indicators. And this overlaps with a later area that we will look at when we look at things like the performance hierarchy, where we look at mission again, objectives, gap analysis, mission statements, and what it means to have SMART objectives, which of course we've seen before. Another syllabus area that we can look at when it comes to our introduction to strategic management accounting is to compare planning and control at the strategic and operational levels within a business entity. So when we do plan, when we do control, there are different levels and therefore different ways in which we would actually have to do that. Yes, there is the strategic level, and this is a strategic paper, and we are strategic management accountants, but we need to also drive what we do at a strategic level down through the levels of the organisation to the operational levels, and actually make those things work at the operational level as well. Another syllabus area that we're going to come to grips with in this recording and in this syllabus area is to assess the use of strategic management accounting. So using strategic management accounting in the context of multinational companies. Now, multinational companies hire a lot of management accountants. They are quite keen to put their accountants through formal training, supporting them through the ACCA, and many of you will be either in or aspire to be in a multinational company. If you're within a smaller company, absolutely fine. If you're self-employed, absolutely fine. Still in business, still need to do what we need to do in terms of planning strategically. However, one of the key things within this paper is that we need to look at strategic management accounting within the context of a multinational company. We also need to discuss the scope for potential conflict between strategic business plans and also short-term localized decisions. Why would there be a conflict between strategic business plans and short-term localized decisions? The company that I work for has a head office in northwest London, and the managing director, CEO, would sit down with his board, and they would think about what they want to do in the organisation, where the organisation is going. There's also a parent company to that based in the Netherlands, and at an even higher level, they will look globally at the different strategic business units, the different divisions. They'll look about where they want the overall organisation to go as a whole, and also being answerable to shareholders, i.e. investors. And all over the world where this multinational company is, different managing directors will be sitting down and they'll be thinking about strategically where they want the business to go, what they want the business to do, the results they need to deliver. So why, therefore, would there be short-term, localized decisions that may be at conflict with that? Well, I'm based in London, and in the London office, there's a managing director for London and the surrounding regions. So I've got a managing director in my London office that's thinking and making decisions. I've got the UK directors in northwest London making decisions on behalf of the whole country, England, Scotland, Wales, Northern Ireland. Then I've got a president and CEO based in the Netherlands who's also making decisions about the organisation globally. Some of those decisions may not all be in sync. Some of their thinking may not all be in sync. And this is something that we need to be aware of, and this is something that we need to take on board. So within this exam, within this paper, this is definitely something that we need to be able to discuss. And the requirement in the syllabus is to discuss the scope for potential conflict. So we need to understand what it means to discuss the scope. Another thing we need to do is evaluate how SWOT analysis may assist in the performance management process. How does SWOT analysis assist in the process? So it's not just being able to perform a SWOT, it's also being able to analyse a SWOT. And you'll find this in many of the models that we look at throughout this paper, is that what we will be doing is not just using the models, but also analysing the models to actually see what is good about the model, what is bad about the model, what are the strengths and weaknesses of the model, what are the opportunities and threats of the model. So it's almost like we SWOT every single model in this exam paper. That's what it means to evaluate, weigh up the pros and cons, the strengths and weaknesses. So what are the strengths and weaknesses of a SWOT analysis? This is one of the things that we will be looking at. Also, we need to evaluate the methods of benchmarking performance. The methods of benchmarking performance. So not only do we need to define benchmarking and be able to discuss what it is if appropriate, but there actually may be more than one way to actually benchmark, and we need to be able to evaluate them, not just discuss them, but evaluate the methods. Therefore, again, what are the strengths and weaknesses of benchmarking in this particular way? What are the strengths and weaknesses of benchmarking in that particular way? So now that we've looked at the syllabus areas, let's now actually try to answer some of those and actually try to put some meat on the bones, if it were. Let's go and have a look at what the actual technical information is that we need to be able to contribute to those syllabus areas in terms of answering them and gaining good marks. So we've already had a look at the strategic planning element. We know that the emphasis is on the importance of information that is relevant to the organisation, that monitors an organisation's environment, i.e. externally. We know we need to have a mix of financial and non-financial. So again, when you're thinking about strategic planning, you're closing your eyes, you're thinking relevant, monitor, especially externally as well as internally. And we also need to think about non-financial as well as financial. We need to think about qualitative as well as quantitative. So those things should come to mind straight away when we think of strategic management accounting. When we think of strategic planning, we're thinking of the rational planning model. What's the rational planning model? It's analysis. Once we've analysed, it's choice. Once we've made our decisions, it's implementation. Going down a little bit further, if we don't use the rational planning model, what other models can we use? Well, there's freewheeling opportunism. Maybe not exactly a model, but it's one way that some people run their business. It's quick. You can be flexible with it. Sometimes you don't even need to actually, plan. You just think on your feet and you get on with it. Good for entrepreneurs, good for fast-moving businesses, good for small firms, good for startups. When you have an organisation that has 4,000 people or 40,000 people, that might not be the best way of doing things. Maybe you need a little bit more structure. Hence, the rational planning model comes into play. It may be a bit more rigid. It may be a bit slow in decision making, but it gives you a framework. It gives you a structure. It gives you that stability. It's robust. Okay, let's talk about SWOT. So, we're thinking about corporate appraisal. Corporate appraisal. We're thinking about looking at the organisation, strengths, weaknesses, opportunities, threats, the internal part, strengths and weaknesses within the organisation, the external part, the opportunities and threats that are outside the organisation. We need to be able to think about strategy. When we're doing a SWOT, we take the information and then we think to ourselves, given our strengths, given our threats, given the opportunities that are out there, given our weaknesses, what is a suitable strategy for us to select? We need to identify limiting factors. Limiting factors can be in sense of resources. It can be in the sense of skills. We need to identify our critical success factors. This is one of the key things for ACCA P5. Identifying those critical success factors, and one of the ways we do that is by performing a SWOT analysis. So when you're thinking about SWOT analysis within P5, within Advanced Performance Management, you're doing a SWOT to identify what is critical, what do we absolutely have to achieve, what do we have to nail in order for our business to be successful. Our critical success factors come through the analysis phase of strategic planning, i.e. performing a SWOT. Organisational survival and life cycle issues. Everything goes through a life cycle, whether it would be a product, a relationship, a marriage, whether it would be a business, an industry, a sector, a country, an economy. Virtually everything goes through a cycle. So, as we go through these cycles. Our aims, our objectives, our mission, and the ways that we control, make sure we stay on track, change with time. So it's important for an organisation to revisit its mission statement. It's important for an organisation to revisit its values, to revisit its corporate strategy, to revisit its plans, to update, to make new. Same thing with a relationship. If you want to change or renew your vows or your values, or depend on things that are important to you. As you grow, as you change, as you evolve as an organisation or as an individual, you need to go back to your objectives and controls, go back to your values and your mission, and update them as you change and evolve and grow with times. Not just yourself as an organisation, but also externally within your environment. Your environment will change, sometimes without even you noticing it. Sometimes you may not feel that you've changed that much, but your environment has changed. The world changes, things move on. So therefore, when you're looking at this introduction to strategic management accounting, when you're looking at strategic planning, when you're looking at the survival of an organisation, you also need to think about these life cycle issues and think about updating and changing with time your objectives, your missions, and your controls. Conflict with short-term decisions. There are problems. And some of those problems, when you're coming to strategic planning, may be unrealistic plans. Unrealistic plans. You may want to achieve something. It may be feasible at the time. It may be suitable. It may be acceptable. But as time goes on, it becomes outdated. You look at those goals and you think, don't think we're going to be achieving that anymore. What do? Do you go back to the drawing board? Do you update your plans? That's what you need to do. Another problem, not just having unrealistic plans, is also having inconsistent goals. Inconsistent goals. Yeah? You want to go out and have fun, but also you want to be a responsible partner or parent. You want to go clubbing, but at the same time, you also want to be a family person. Yeah, so you need to have goals that are consistent. Now, yes, you can do both. There are ways you can do both, and within an organisational context, there are ways that you can focus on quality, but at the same time, be good value for money, not to be too expensive. You can grow the business and expand, but at the same time, the opposite to growth is being stable, being robust, having things that are reliable and dependable. Sometimes when you're growing very quickly, you can be a little bit shaky. Hold on tight. It's going to be a rough ride. That's typically what fast growth means. So maybe we want slow and steady growth. One of the things when you come to strategic planning, one of the problems, one of the issues, especially when it comes to short-term decisions, unrealistic plans, inconsistent goals. The other thing is poor performance measurement. Now, we're going to be looking at strategic performance measurement a little bit later on as we go through these revision aids. But before we get to strategic performance measurement, one of the things we need to do, even from the planning stage, from the get-go, is to try and ensure that as we measure our performance, we have good measures. And again, in this ACCA P5 strategic performance measurement, one of the key things we need to do is make sure those measures are up to date for a modern organisation, for the current business climate that we're in, for this age. We're young, most of us. Most of us studying and learning at this stage are young accountants, and we're coming up in the world, and we will be leaders, sometimes pioneers. We will shape the organisations that we are involved in and also the world that we live in. We may influence or have an effect on hundreds, if not thousands of lives. both people that work for our organisations as employees, and also through the things that we do in terms of the products and the services that we help sustain or create. So therefore, as people coming up, as strategic management accountants, we need to help organisations update their systems. Yeah, we're seen as young whiz kids with bright ideas. Some of the older people may be a bit intimidated by us because we're coming from our ACCA colleges with all these ideas. We need to be able to find ways of improving the system, but also understanding the culture. We need to make sure that if performance is being recorded poorly, that we can contribute good ways, good measures, suitable measures, feasible, acceptable measures of looking at, capturing, recording, monitoring and controlling performance. I had a meeting with my boss the other day and I said that I'm not too sure about certain aspects of the way this organisation monitors performance. First thing he said to me was, what do you think we could do? What do you think we could change? He valued my opinion. I could bring my opinions to my boss. We could devise something. We could do something. The rest of the organisation will look at it. If it's good, we'll roll it out across the country. If it gets noticed that the UK are doing something well, we'll roll it out across the world in our global organisation. And when other organisations look at us and say that is something good that they're doing, they'll benchmark themselves against us. And therefore, throughout the whole world in our industry, that idea will be taken on board. And other industries may say, well, actually, that industry does that. Maybe we should do that too. So from an idea coming from one individual, it can actually have an effect and, if you like, yes, it sounds quite grand, change the world. We could change just the organisation that we're in, the department that we're in. That could be enough. But as a management accountant, that's one of your roles to do, is to actually improve the performance of your organisation. Something we shouldn't be afraid to do, and something that we definitely will do in our careers if we're doing a good job. Finally, in this introduction to strategic management accounting, we'll look at benchmarking. Now, remember, as part of the syllabus, we need to evaluate the methods of benchmarking performance. So therefore, we need to acknowledge that there are different methods of benchmarking. We could say there are different types of benchmarking. And one of the methods, or one of the types of benchmarking, is internal benchmarking. I work for the London and surrounding regions division of my organisation. There's also a division in the north of England. We can benchmark ourselves against each other. We can exchange information. We can see what we do. In fact, one of the ways that we do actually benchmark ourselves against each other, even within the finance department, is that I produce a balance sheet every month. Another region performs a balance sheet every month. And as accountants, we get together and we look at each other's balance sheets. We critically evaluate and assess each other's balance sheets. We benchmark each other's balance sheets against ourselves. So there's internal benchmarking. There's also functional benchmarking. Functional benchmarking may be that we take an organisation that is external to our own. They're not a direct competitor. They're not necessarily in the same industry as us, but they have a function. So therefore, I may look at the balance sheet of an organisation or a department within that organisation. Maybe it's a London and surrounding regions department of a completely different organisation and a completely different industry. But it could be my mate. It could be somebody that I know from my Leaders of Tomorrow programme who's in a completely different industry. Maybe they're in the food retail industry, while I'm in the construction industry. They are looking after the London and surrounding regions of their food retail industry. I'm looking after the London and surrounding regions of my construction industry. They produce a balance sheet, I produce a balance sheet. We both get together, we look at each other's balance sheet and we compare them. Compare and contrast, we benchmark each other's balance sheets against one another. Completely different industry, We're not in competition with each other. I'm building buildings, they're selling food, but the functional element means that we're both in finance, we're both part of the finance function. So therefore, there's things we can learn. Now, other functions may be HR, it could be operations, it could be marketing. So there's many different functions within an organisation where we can actually functionally benchmark ourselves against one another. That's a functional type of benchmarking, which is different to internal, because internal is within the organisation, functional, external to the organisation, but not necessarily a direct competitor. And then finally, we have competitive benchmarking. Probably one of the most useful forms of benchmarking we can ever do is competitive benchmarking, but of course it's one of the most difficult, because if we are in direct competition with somebody, are they really going to show us their balance sheet, if balance sheets are what we're benchmarking? You know, if they have a fantastic method of building buildings, are they really going to sit down with us and share that with us and say, look, this is how we build our buildings, show us how you build yours, and we're going to compare, we're going to benchmark against each other. So competitive benchmarking is one of the most difficult ways that we can actually choose as a method of benchmarking. That being said, you may not always see this in the textbooks, but in my experience, one of the best ways that you can competitively benchmark yourself against your competition is to hire, if they're willing, one of their staff. One of the reasons why I was hired in my current construction company is because I was helping to build. I say built because I believe it's a team and I was involved. So my previous company built a fantastic building, world renowned, London 2012, involved, built fantastic buildings, couple of buildings we built. That was really valued. I was the project accountant for that. Therefore, I was hired by my current company because I had experience in doing something that my company does and wants to do and wants to be good at. One of the things that companies value about having experience is that you, as the person with experience, can compare what your current company does to what your previous company does, and you automatically benchmark, and you're able to bring the good things from your previous company into your new company. So even though it may be difficult to obtain information if you're competitively benchmarking, because your competitors are not going to just hand over information, by actually being involved in the labour market for your industry, you can actually hire people that have the skills and therefore are able to benchmark your organisation against your competitors. So, let's look at some advantages and disadvantages of benchmarking. We've looked at the types, we've looked at internal, we've looked at functional, we've looked at competitive benchmarking. Let's now have a look at some of the advantages and disadvantages of benchmarking. So, why benchmark? What's good about it? Well, you're comparing yourself against somebody. So, once you are able to look and analyse at somebody else, another organisation, another department, you're able to learn. So one of the key good things about benchmarking, one of the advantages, is that you get to learn. You get to learn about somebody else. You get to learn about another organisation, another department. Once you've learned something, what do? You take it on board. You implement it. You implement the change. So therefore, one of the key things about benchmarking, one of the good things that can come out of it, is that it can help you to change for the better. So you learn, you change. These are good things. Also, you may be able to put 2 and 2 together and come up with more than 4. In other words, you may be able to take something good that you've learned from the other organisation, take something good that you already do yourself, put those 2 good things together and come up with something that's even better, i.e. innovation, something new, something innovative. Yeah? So innovation is one of the key things that can come out of benchmarking, because you can actually get more than the sum of the parts. So to recap, 3 advantages of benchmarking: we're learning, good. That's good. We like that. That's an advantage of benchmarking. We get to learn something. 2, we get to implement some changes. Change is usually a good thing, especially when we're learning and we implement the changes. So changing for the good, changing for the better, moving onwards and upwards and forwards, that is one of the good things about benchmarking. We get to learn, we get to change, and then finally, if we're good, if we're lucky, if it's a great exercise and we can think outside the box and put 2 and 2 together to get more than 4, we can innovate. We can come up with something new. And that is one of the key great things about benchmarking. So what are some of the disadvantages of benchmarking? Well, one of the things about benchmarking that's probably not that great is that we are looking at somebody else. We're comparing against somebody else. So yes, we might be learning, but it's not like we're leading the way. If we're looking at somebody else, almost copying somebody else, imitating somebody else, doesn't kind of put us in a position of being at the forefront. You know, we're not seen as the leader in that sense. Now, you may well steal all their ideas and become the leader, or you may collaborate with them and support one another and, you know, both be leaders in your own right, and you could both improve each other. But it is quite reactive to look at somebody else, then look at yourself, and then change and implement. You're reacting to the other person that you're benchmarking yourself against. So that is not always the best way to be. Sometimes you might just want to be able to just look at your own organisation, yourself, and implement changes and be a leader, rather than being reactive and looking at somebody else, waiting for somebody else to do some good things before you then do those good things yourself. So one of the key disadvantages of benchmarking is that it is reactive. Also, one of the things about benchmarking is obtaining information. Now, if it's internal, that should be quite easy to do, unless, of course, the other division don't like you, or the other, functional area don't like you. Then they may not be willing to share with you. But if you have good relations internally, then you should be able to exchange information freely. So obtaining information internally probably isn't the hardest of the 3 types of benchmarking. Functional, you're dealing with another business. I mean, you know, my mate from the Leaders of Tomorrow program, he might be quite happy to share his food retail balance sheet with me. But what about his boss? And what about corporate policy of, not disclosing, confidential company financial information? Is he actually really allowed to sit with me in a coffee shop and, pull out his company balance sheet and discuss that with me, being an external party, even though we are mates? So again, obtaining that information to do functional benchmarking might not always be easy. Even if it's formal functional benchmarking, where 2 organisations formally agree to support one another in functional benchmarking, there may be limits on the amount of information that both parties are willing to share, and one party might actually be more willing to share than another. And of course, one of the most difficult aspects of obtaining information is competitive benchmarking. Even if you hire an employee that was once part of your competitor's organisation, there are rules, there are limits, and they may have information that quickly goes out of date. Of course, if they're working for your organisation now, then whatever past information that they had will increasingly become out of date. And of course, there are ethical issues if you are obtaining information from your competitors, from a source within the competitor's company. So there are issues with obtaining information, especially from the competition. So when it comes to benchmarking, one of the disadvantages, as well as being reactive, is that it can be difficult to obtain information. It can be unethical in some instances as well. Also, when it comes to benchmarking, well, what are you doing? What are you benchmarking against? And why? What have you chosen? What has your organisation chosen to benchmark? And is what you're benchmarking, yourself against like for like. Can it be comparable? What to benchmark? Choosing the activities for benchmarking is also one of the issues. You'll come up to my boss, say, let's do some benchmarking. What are we going to benchmark? We benchmarked each other's balance sheets. Okay, fine. What else are we going to benchmark? So actually choosing the activities and actually seeing the value of, benchmarking those activities is one of the key things that can be seen as a disadvantage to benchmarking, is actually deciding what actually is important to benchmark. So just to recap on this chapter, our introduction to strategic management accounting, we're explaining the role of strategic management accounting in the strategic planning and control process, i.e. that role is to provide information that's relevant, that monitors externally, and also and non-financial, whereas traditional accounting is information that's usually kind of like the past, historic, it's usually internal, and it's usually financial. So the strategic element brings the non-financial, it brings the future orientated, it brings the external to the fore as well. We have also discussed the role of corporate planning in clarifying objectives. We know that we need to have clear objectives. We know we need to make strategic decisions. We need to check our progress towards our objectives. How do we do that? Well, we know that we have got a SWOT analysis. We know that there can be conflict with short-term decisions, unrealistic plans, inconsistencies in those plans, and also the measures that we use for performance measurement need to be good. We need to compare planning and control at the strategic and operational levels. So remember that we need to be aware of the different levels. We also need to assess the use of strategic management accounting in the context of multinational companies. So again, just being aware that when we do strategic management accounting, we need to be aware of the setting, especially within a multinational organisation, the scope for potential conflict between strategic business plans and short-term localized decisions. We need to evaluate a SWOT analysis and how that may assist in the performance management process. Remember, a SWOT can help us to identify our critical success factors and also things that may be limiting us, i.e. limiting factors. A SWOT analysis can also help us to identify a suitable strategy, help us to select a suitable strategy. So that's part of our evaluation of how SWOT analysis can assist in the performance management process. And we've also evaluated the methods of benchmarking. So we've got our internal, our functional, our competitive benchmarking. We know that the advantages of benchmarking are, of course, that we may learn something new, we may change, we may innovate. We know that the disadvantages of benchmarking are that it may be quite reactive, it may be difficult to obtain the information, and also we actually need to choose the activities to benchmark, which can also be a matter of contention. So thank you for listening to this ACCA P5 Advanced Performance Management Introduction to Strategic Management Accounting. I've been Anthony Andrews from London, and please listen to the other revision aids to help you with your ACCA success. Thank you.